Hi, I'm Dan Dixon from the London Capital Markets team at Knight Frank.
And hi, I'm Kate Horton, London Capital Markets at Knight Frank.
And today we're here to talk about the key trends in the London capital markets and the capital targeting London real estate at the moment. So Kate, a question for you first. How important is private capital targeting London real estate for the London office market?
It's a good question, Dan. Very important is the answer to that. We saw a huge resurgence of the private investor in the wake of the September 2022 mini budget. And in fact, if you look at the statistics for 2022, around 80% of all deals done across London were done by the private investor. Now, these investors typically focus on lot sizes below 75 million. For wealth preservation, they can usually make quicker decisions without being subject to the same return hurdles as some of the institutions and property companies. However, if we look at the statistics for this year so far, we can actually see that private investors only accounted for around 40% of all deals, which suggests that there has been a return of the other investor groups, such as the institutions and the property companies, which are typically focusing on those larger lot sizes. So with all this talk of private capital in London and their dominance in 2022, which other investor groups can we expect to see active throughout 2023?
Interestingly, sovereign wealth funds and public pension plans all increased their allocations to real estate last year. And a significant number of those are planning to further increase their allocations to real estate off the back of a number of very reputable capital surveys. Interestingly, that would give them some very significant firepower and a lot of capital to deploy in the current market. So we expect those parties to be active over the next year or so. In addition, there are a number of public and private companies that are looking to diversify around the world. And we have seen APAC leading that trend. So Link REIT, China Chem, Sun Ventures have all cited diversification as their primary driver for investing into London in the last 12 months. Interestingly, our trip to Hong Kong and Singapore have shown us that there are significant requirements for both wealth preservation and distribution yield-driven investors who are all targeting London. And so, Kate, do you think large lot sizes will continue to trade in the current market?
So when we talk about large lot sizes in London, we're typically talking about deals of around 100 to 200 million pounds plus. And typically when we have a slightly difficult market or periods of market uncertainty, we see less of these deals of scale trading as investors with the capability to do these deals adopt a bit of a wait and see approach. And with debt failing to be accretive at current pricing levels, we're seeing a reduction in firepower from these large scale investors. However, in the turn of the year, so into 2023, we have actually now seen 4 deals in London transact of above 100 million. So naming a few key ones, we've got China Chem's acquisition of 1 New Street Square for around 350 million, which Knight Frank sold for Landsec. We've seen the recent completion of Winchester House to Castle Forge and Gamuda for around 257 million. We've also seen St Catherine's Dock being acquired by CDL for 395 million. And finally, Lion Plaza recently being put under offer. And what these deals are is deals of scale, and that brings confidence to the market to show that these larger lot sizes are still liquid.
Okay, and you've just mentioned 1 New Street Square, which we obviously learned a lot on. Which ESG benchmarks and accreditations are investors most focused on at the moment?
It's a really good question, and that landscape is constantly evolving and developing in the capital markets arena, just like it is in the wider ESG field. And in relation to that particular sale that you mentioned, we saw quite a few European institutional investors focus quite heavily on EU taxonomy compliance and also CREM analysis. And when it comes to CREM analysis, what investors want to try and understand is obviously stranding risk and stranding date and what capital expenditure they're going to need to invest in that building to take it from where it is now to a future, more ESG compliant version of itself, effectively.
And how many buildings do you think there are currently in London that fit the requirements of investors at the moment?
Well, for those particularly strict ESG compliant investors, I think there's a real scarcity of premium buildings around. And I think actually there's a very strong case for when those do start to come to fruition, those do start to trade, to see a premium attached to those prices. Neighbours UK, for example, is really helping to drive forward at a fast pace our understanding and analysis of the operational carbon impact that a building has. And once some of those buildings have that rating and have actually come to market and sold, we're going to really start to build up some data behind that.
And so for 2023, in the context of ESG, what should investors be looking out for?
There are a number of things, but I see it as sort of two key things on the very short-term horizon. The MEES regulations, it being unlawful to have a building that has an F or a G rating, even for leases that are currently in place, not just for new lettings. So that's really significant. And secondly, the planning horizon is changing quite significantly. So very recently, the City Corporation, for example, have recently put out some new guidance and policy that says that all developers will need to consider the embodied carbon impact of various schemes before submitting a planning application. So that's going to have some really significant ramifications for developers in the way that they analyse their schemes for viability. So we've talked about one really important theme, ESG, in our market at the moment, but changing the topic slightly and thinking about something else that we're likely to see become more prevalent. Are we likely to see a rise in the amount of joint ventures in London this year?
In short, yes, we believe so. We think there are two key variables that are going to drive that trend. The first is the notable funding gap that Lisa has mentioned, and the fact that at the moment, in most instances, debt is not accretive. So we see there being a substantial opportunity for joint ventures to fill that gap with various structured solutions, whether it's straight joint ventures or whether it's preferred equity, allowing developments to still be delivered. And also, we previously mentioned the sovereign wealth funds and public pension plans who we think have got a significant amount of capital to deploy. Interestingly, they typically have large capital allocations with small direct real estate teams, which makes them particularly good partners and providers of capital within the joint venture arena. So we anticipate those parties being very active. One point that I would note is that they are obviously very, very focused on the prevailing trends of the market. So expect them to be very focused on ESG, as you've mentioned, focused on best-in-class assets and connectivity across London. It's likely that secondary assets will still continue to suffer in the same way that they will with private capital.